One number silently screamed crisis before 2008. Almost no one listened. It wasn't a housing stat. It wasn't a Wall Street headline. It was the 10-year Treasury Yield, a quiet signal from the bond market that something was deeply wrong. What is this mysterious number? How could it predict a financial collapse that blindsided the world? And here's the real kicker. Are we ignoring it again today? The 10-year yield isn't just a number buried in financial news. It's a pulse check for the entire economy. When it moves in strange ways, especially compared to shorter-term rates, smart investors start paying very close attention. Today, we're going back to the early 2000s to understand how this one metric forecasted one of the biggest financial disasters in history, and what we can learn from it now. So, what is the 10-year Treasury yield? In simple terms, it's the return investors get when they lend money to the US government for 10 years. It's one of the most important interest rates in the world, affecting everything from mortgage rates to student loans and corporate borrowing. But beyond that, it tells a story. When investors are confident about the future, they demand higher yields. When they're scared, they pile into safe assets like government bonds, driving yields down. That's why economists and analysts obsess over this number. It's a window into how big money sees the future: economic growth, inflation, and risk. Even more telling is how the 10-year compares to shorter-term yields like the 2-year Treasury. Normally, long-term yields are higher, but when short-term yields climb above long-term ones, that's called an inverted yield curve, a strange and powerful signal that recession may be looming. Before the Great Recession, this exact pattern emerged. The bond market was screaming caution, even while stock markets were booming. And yet, most people weren't paying attention. Let's rewind to the mid-2000s. In 2006 and 2007, something unusual started happening in the bond market. Short-term yields, like the 2-year Treasury, began rising above the 10-year. That's the inverted yield curve we just talked about. And historically, that's a big red flag. It had happened before every major recession in modern US history. But in the early 2000s, most people ignored it. The housing market was booming, stocks were strong, confidence was high. But the bond market was telling a different story. Big institutional investors were piling into long-term treasuries. Why? Because they were nervous. They wanted safety. That demand pushed the 10-year yield down, while short-term rates stayed high, partly due to the Fed raising interest rates. This inversion didn't just show up, it persisted. Month after month, the yield curve stayed upside down. Wall Street analysts were divided. Some said the signal was outdated. Others warned that trouble was brewing. By late 2007, cracks were already forming. Mortgage defaults were rising. Subprime lenders were folding. But the signal had been there, quietly blinking red, long before the headlines caught up. So why was the 10-year yield right when so many experts were wrong? Because it wasn't based on hype or hope. It was driven by fear, data, and deep financial instincts. Bond investors aren't in it for quick gains. They're in it for safety, stability, and signs of trouble. And in 2006 and 2007, they saw cracks forming in the foundation. Subprime mortgages, loans given to people with shaky credit, were being bundled and sold like gold. Housing prices had skyrocketed. Everyone assumed they'd keep climbing, but bond investors weren't buying the dream. They saw rising defaults, unsustainable debt, and a system built on risky bets. That's why the 10-year yield stayed low. Investors were locking in safety before the storm hit. When the recession finally arrived in 2008, it didn't come out of nowhere. The signs were there. The yield curve inversion was just one of them, but it was one of the clearest. It's like the bond market was whispering a warning to anyone willing to listen. The tragedy? Most didn't. And by the time the banks collapsed and markets plunged, the 10-year had already told its story. The big question now, have we learned anything? Since the Great Recession, the 10-year yield has gotten a lot more attention. Economists, investors, even regular folks now track it. But the real test came in recent years, because guess what? The yield curve inverted again. In 2019, just before the pandemic. Then again in 2022. And once more in 2023. Every time whispers of recession began to spread. Each time people debated, is it different now, or is history rhyming? The truth is, the 10-year yield isn't perfect. It doesn't predict timing, it signals risk. But it remains one of the most reliable early warning systems we have. The lesson? Don't ignore quiet signals. Just because the stock market is booming or unemployment is low doesn't mean we're in the clear. Sometimes the most important insights aren't in the headlines, they're in the bond market. So next time you hear the yield curve has inverted, don't shrug it off. That little phrase carries a lot of weight and a lot of history. Understanding this metric doesn't just make you smarter. It might help you see what others miss. The 10-year Treasury yield isn't just an economic number, it's a storyteller. It whispered warnings before the Great Recession, and it's still speaking today. If there's one lesson to take away, it's this: signals matter, especially the ones hidden in plain sight. If you found this breakdown helpful, make sure to hit that like button, subscribe for more, and drop a comment.